Canada has trimmed its key policy rate by 25 basis points to 4.25%. So though inflation is cooling, our next guest says Canada is still struggling in certain areas. What are some of the challenges facing Canada's economy at this point, and how is the latest rate cut influencing our next guest's asset allocation perspectives? Joining me now to unpack all of this and more, including what he anticipates hearing later this month from the Fed, is portfolio manager David Tulk. Hi, David. Great to see you.
It's great to be here. Thank you.
Enjoyed watching yesterday, listening to the press conference from the Bank of Canada. We'll invite everyone to send their questions in for David for the next little while. We know what the news is at this point. What did you think? What struck you?
For me, I think it was fairly clear that the Bank of Canada wants to continue to ease interest rates. That was baked into a few of the comments that the governor made in the press conference that followed. So to me, I think the Bank of Canada recognizes that inflation is close enough to where it needs to be, and they're now increasingly worried about the impact that the lag of tighter policy is having on the real side of the economy. So the fact is they need to get the overnight rate much closer to its neutral setting, which implies continued rate cuts, I think as far as the eye can see from the Bank of Canada.
Yeah, so in total, I mean, what would you say? Is there a range?
I think we'll have to see. I mean, the bank did say they will take it on a meeting by meeting basis, but I think if you read through that and just look at the projection of the economy, it's clear that the economy is slowing down, the unemployment rate is creeping higher. So to see something in the neighborhood of 5, 6, 7 more rate cuts, I think 25 basis points at every meeting, I think that's a reasonable expectation. I don't think the bank's going to panic and start cutting in 50 basis point increments. That was, I think, the first question from the press conference, just to sort of play out that tail risk scenario. And I think the bank handled it very well by saying that, yes, there are scenarios certainly out there that would demand more monetary accommodation in a symmetric fashion. They also said there are scenarios where the bank would even pause cutting interest rates. So I think that's just really just properly describing the range of potential outcomes. But I think where I would see it going from here is just steady 25 basis point rate cuts, just until there's some evidence that they don't need to be as worried on the real side of the economy, and that the labor market is starting to stabilize, and GDP per se is also growing at a respectable rate.
Okay, we'll go into GDP in just a minute. Talk a little bit about the imbalances in any economy. They are everywhere. In Canada, it seems like the massive imbalance is sort of the housing/mortgage debt story. Is that the biggest piece, and what do you do with a blunt instrument, basically? How does it tackle that?
That's the issue. So it's a very familiar narrative, I think, hearing from us as a team. We've been long worried about the imbalances that have existed in Canada's economy. Canada really has never taken its medicine when it comes to running an unsustainable level of household debt. So other economies have made their adjustments. Canada never did. And now we've had the clear catalyst in the form of higher interest rates, and that's slowly reverberating its way through the economy. And it's important to recognize that we're nowhere close to being actually out of the woods yet. So if you think about the 5-year rolling reset of mortgages that were originated in the darkest days of the pandemic when interest rates were at generational lows, that's still coming. Those resets are still taking place over the next year or so. So I think, again, the reminder that monetary policy works very gradually through the economy, and the extent that that will continue to weigh on the economy, I think is a very important point to make. I think it's also important to recognize that even if monetary policy comes down and the bank continues to cut in these measured steps, those mortgage borrowers are still facing a higher interest rate burden as they reset. So it might, I think, as the bank described, it doesn't eliminate the challenge. It might lessen the pain to some extent, but I think Canada does need to face a period of a rebuilding of household balance sheets. And again, this is something that other economies have gone through. The US took the better part of a decade after their mortgage cycle, so Canada has to basically experience that. So I would be very not surprised to see the Bank of Canada, or at least the Canadian economy, moving at a very slow rate for the next couple of years. Really, as every dollar of income that households gain, that has to now be compartmentalized into paying back some debt, which leaves a smaller share to really finance ongoing spending. And it's that headwind, I think, that just leaves the economy growing at a slower rate. And that also means, unfortunately, that there's greater vulnerability to the type of economic shocks that crop up time to time.
So the growth story, and we did see GDP coming in. It had a headline number, but it had an an underneath number that was more concerning. Part of that story actually comes into the discussion of one of your most recent papers that you're putting out, and it tackles immigration and its place in sort of the growth story of Canada to an extent, doesn't it? Do you want to just sketch a bit what you're aiming at in that?
Yeah. No, absolutely. So you're referencing the thought leadership piece.
Yeah.
It's actually coming out today. Okay. So I encourage everyone to take a look on fidelity.ca when that's available. So yeah, the immigration story, I mean, it's something we've seen. It's not unique to Canada, but I think it's especially pronounced in Canada. And I think it's fair to say that in the long term, immigration is very positive for an economy. It adds vibrancy to the labor market. It leans against some of the demographic forces that I think a lot of economies are going to struggle with for decades to come. The only problem is that getting to the long run can be very challenging. And as we've seen, a large increase in immigration has really exceeded the ability of the economy to absorb that influx of population. So all of the services and all of the infrastructure that needs to really exist, and this includes housing, that needs to be put in place so that immigrants are able to at least contribute positively right out of the gate into the economy. So we really haven't seen that. So the upshot for Canada is that you've now seen this pool of underutilized labor. So that's contributed to higher unemployment rates. That's also really weighed on productivity. And the productivity story is, again, something that we and my colleagues have talked about at great length, but this has added an additional headwind to the economy through that channel. So all of that just means that you're going to need to see some time for all that population to be absorbed and the rest of the economy to catch up. And so, yeah, so in the long term, unambiguously positive, but I just think there's a lot that has to happen. And in the interim, I think it just adds an extra challenge to Canada's economy.
What does the loonie do in the interim? In theory, it should drop, and maybe that's good on an export side of things. I think some of your colleagues have said recently, it's almost surprising how well it's kind of held up. Right. Recently, we've had a couple of rate cuts already. We were ahead of other people on that. What do you think is, again, sort of the mechanism for letting off steam of what's going on in the economy?
Yeah, I think the currency is a really important rebalancing mechanism within the economy. So as we talked about, there has been a lot of growth that's been driven by the domestic economy and particularly housing and consumer spending. So that needs to take a bit of a back seat, and you want to catalyze other parts of the economy to sort of make up for the slower growth you're getting out of the consumer and the housing market. And one of the key sources of potential, at least in Canada, is that you rely on the export market. And the export market as a small open economy is really important to Canada. So the challenge with that narrative, though, is that, again, the global economy is arguably slowing down. China in particular, which was really a catalyst for strong export demand from Canada, is also in a pretty tough spot right now. You've also seen a lot more in the way of tariffs and other barriers to trade. So globalization as a whole has retreated. So there are some headwinds to relying on exports. So what do you need to do? You effectively need to make the Canadian economy cheaper and the goods that Canada produces to be cheaper, to be more competitive. And that would come through the way the currency moves. So I think the longer term direction, and this is something that really underpins a lot of the core views we have when it comes to positioning, is recognizing that through time the currency will be weaker than where it is today. So that's the one horizon to consider. Now, we also can contemplate shorter term horizons as well. So everything I've talked about when it comes to Canada, I think is also generally well appreciated by the market. And the currency in particular is a really good mechanism to take into account a lot of those factors. So what we've seen is that the Canadian dollar has actually priced in a fair bit of that bad news already. So we can see it. Yeah. So we can see it in surveys. We can see it in some of the CFTC positioning data that really shows, large net short positions around the currency, and that's allowed, I think, us from a tactical perspective to say, well, we do believe that the longer term direction of the currency is lower, but there is some scope for a short covering rally. We've seen that over the last couple of weeks. So what we have done from a positioning perspective is to scale down the size of the underweight we have to the currency. That's not to say we're more optimistic on Canada per se, especially the domestic side of Canada. We just recognize the market's giving us an opportunity to recalibrate the size of the underweight to position for the type of short covering rally that we're seeing and could potentially carry on from here. And when that part of the market, at least when that sentiment channel has run its course, I think that's a logical place for us to maybe reestablish a larger short position or underweight position in the currency. So it's a bit of a nuanced story because there are a couple of horizons to consider.
So it's very interesting how tactical you can be, and as you say, there are too many people on that side of the boat. Perhaps the Canadian dollar short, essentially, and it needed to literally rebalance. Let's talk about the U.S. because then we'll go further into the asset allocation piece that you've got here. You've said before the U.S. It's not so much that they have the luxury of deciding whether to cut, but there's something to that. There's something to that. They're in a very different position.
Yes, absolutely. No, it's in stark contrast to Canada, where you could argue that the Bank of Canada is behind the curve, so they really need to cut to accommodate an economy that is slower. So if you think about the U.S. and the decision that the Federal Reserve will make in a few weeks, they're in the position where they can say that the U.S. economy is fundamentally healthier. So there is some slowing, certainly. I mean, we've seen this across a large number of data points that there are parts of the U.S. that have slowed, but thus far, I think the labor market has held in reasonably well. And so from that perspective, the Fed would see their policy decision as maybe a little bit more of a fine-tuning exercise. They do recognize that policy is restrictive. It doesn't need to be as restrictive as it is today. So to see them cut a little bit in response to some evidence that the economy is slowing is consistent with that soft landing story. And this hinges also back to the conversation we just had around productivity. So as much as Canada faces productivity challenges, the U.S. I think is really able to rely on a productivity tailwind to provide a stronger level of underlying economic activity and growth, and that can make the economy more resilient to the tighter policy that we've seen out of the Fed. So again, that just means that the neutral rate, if you want to think of it in that context, would be higher in the U.S.
Like
than
3%?
It is. Possibly, yeah. No, if you think about it from that perspective, I think you could see. Again, the upshot is that the Fed probably does not need to cut certainly as much as the Bank of Canada does, and similarly does not need to cut, I think, even as much as the market is currently pricing. And I think the market may be a little bit too worried about some of the near-term economic data that's come out.
So when we take a look at sort of the differential story, the interest rate differential story around the world, and Canada also is not entirely unique. There are other countries that are going through and need to cut faster to get interest rates down for different reasons. But do you think that if Canada was able to just sort of focus on its own little myopic economy, we'd be cutting even faster? Or do we have to worry about the interest rate differential quite a lot?
Yeah, I think that's a very difficult question to try to answer because, again, Canada is a small open market economy.
It's totally theoretical.
Yeah,
so
it really does drive a lot of its performance from what happens in the rest of the economy. But I think if you were to just maybe isolate, the housing market, you could say, well, I'm worried about the impact of consumers facing reset risks over the next couple of years. So that in isolation might argue for a lower interest rate today potentially. But you're also aware that the shelter inflation component has been elevated too because of that shortage that we've seen in housing and all the demand that's coming in, partly from immigration, partly from other factors. So that might even say, well, if you're just looking at that one tiny piece of inflation, that would argue for a tighter and even higher interest rate potentially. So this really gets back to the core issue that monetary policy is such a blunt instrument that the Bank of Canada or any central bank doesn't have the luxury of being able to say, well, okay, for this part of the economy, I want interest rates to be X, and for this part of the economy, I want it to be Y. But I think when the Bank of Canada looks at the totality of the inflation picture today, it's one where, again, it's close enough to their target. And remember that the Bank of Canada has a target, it's a range of a target from 1% to 3%. So they don't necessarily need to get 2.0000% to be comfortable, but they recognize that the balance of risk, I think, has shifted from being worried about inflation, being unanchored and pushing higher, to now wondering whether the growth side of the economy is able to hold its own. And that's, again, an open conversation for sure.
Let's go into allocation a little bit. You mentioned the less of an underweight to the loonie and the reasons behind that. It may be temporary. But let's go into asset allocation ultimately. At the beginning or the end of last year, about a year ago, you were really looking at U.S. equities as sort of the biggest story within the asset allocation. What's changed since then?
So in terms of the changes, well, let me take a step back and look at the broad positioning. So we've kept a lot of our really high-level positioning when it comes to the equity beta exposure as well as duration, more or less unchanged. So again, we believe that the U.S. can pull off the soft landing. We're really worried about Canada from a longer-term structural perspective. We don't love duration in this particular phase of the market. We still have, again, maybe some lingering inflation fears that we want to protect against.
Further out?
Further out.
That's the duration piece.
And that's all consistent with that. But where we've made some changes, I think, is really on the country level equity exposure. So as I mentioned, yes, we are certainly worried about Canada's outlook, but a lot of that bad news has already been priced in. Okay. And another competing narrative is that we're also more constructive on commodities. And as we know, Canada has a lot of commodities. So you want to be able to really fine tune how you get exposure to Canada's market. So we've trimmed the underweight to Canadian equities and as well as the currencies somewhat. We've added some global commodities on the other side of that because what we really want to get is the commodity piece of Canada as opposed to the domestic economy piece. So that's the pair trade that's been done there. And we've also reduced a little bit of our overweight to the US. So as we mentioned, as we talked about, the U.S. is still a structurally strong economy, but it has been very narrowly led from the growth sector. So I would just be mindful of saying a lot of this good news has been priced in. And I think the view of having a little bit more balance between a U.S. exposure, an EFI exposure, and an EM exposure warrants a little bit more of a straight line allocation sort of across those three markets as opposed to really being concentrated in the U.S. So that's another piece of the allocation changes that we've made.
I'd love to get your thoughts on, as we approach the Fed interest rate cut, we think. The equity market's freaking out a little bit. Now, we had what happened in August, and there was a bit of a trifecta of things going on there. But this week has been rocky. Equities are trying to sort themselves out. There's been some selling of big tech. Would you say that's all in line with, I don't know, just some change-ups in leadership, what's moving around?
Yeah, I think so. I mean, I think the irony in August is that if you just took the entire month of August
it was fine. Yeah.
At the end of the month, it looked fine. I mean, you missed all that volatility. You had the Japanese carry trade unwind. You had a lot of concerns around the economy. Also, hinging on a non-farm payrolls print, which we'll get another dose of that tomorrow. So a lot of that fear was more of a spasm of market illiquidity and just some recognition that the market had done so well for so long that it's helpful to remind yourself that markets can go down periodically, even if there's nothing fundamental behind the story. And we might be seeing a bit of an echo of that as well. It's just recognizing that, again, it's been such a growth-led market in the US in particular, but other markets around the world as well, that you could see a bit of broadening in that. You could also still get that residual concern around economic data. And as I mentioned, there is some pockets of economic data that look a little bit less optimistic than they would have been previously. But I think ultimately, you want to see through a lot of that sort of very near-term economic data. Any single data print is going to have a lot of volatility. It's an estimate in the best case scenario. So really trying to understand where the trends are in the economy, and that to us is the guiding light for how we think about the allocation. So again, having an underweight to Canada, a little bit smaller than what we had previously, but also a balanced overweight from between the US, EFI as well as EM. I think that's the prudent course to take today.
So let's go to sort of the other side of the portfolio, ultimately the fixed income side of things. Been lots of auctions, been lots of companies raising money and in anticipation of rates coming down and just the cost of capital being a bit less. Just take us through sort of where you think that belongs, and if we need to be as sort of a ballast against risk, need to be there as much. I mean, some will say the Fed put is there, and risk is maybe okay. I don't know. Take us through what you think.
Yeah. So on the fixed income side of the portfolio, I mean, we're still, again, underweight investment grade. We've balanced that with a number of allocations into credit and plus sectors, and a lot of those decisions are really driven by the conversations that we have with the underlying managers, that we're confident in their ability to add a lot of value to the portfolio through individual security selection. So even if you might be worried about a plus sector in an index sense, like high yield or anything else like that, we, again, are happy to have that allocation with those managers, because we know that even if you see a widening in high yield spreads, their ability to pick individual securities is something we want to make sure is included in the portfolio. So that justifies the allocation we continue to have to those plus sectors. But I think on the duration comment as well, again, this is something that's really interesting because...
It's really interesting because you would think, anyway, we kept sort of hearing from actually bond managers that duration's coming. Like we're going to be looking at that soon. It's not been the case so much this year so far.
Yeah, I think in the Canadian context, it's really interesting because as much as the Bank of Canada has cut and is likely to continue to cut, if you look at 5-year, 10-year government bond rates, I mean, they've effectively priced in that full cutting cycle. So I imagine this nightmare scenario where the Bank of Canada recognizes that they need to have lower interest rates to help cushion the hit to the housing market, but 5-year yields and 10-year yields don't really react to what the Bank of Canada has done because they've already moved. So that, again, if you had to think about that scenario, you might even need to see even more cutting out of the Bank of Canada. So simply, getting to neutral isn't good enough. You've got to go well into accommodative territory. So that's, again, something that we want to be mindful of in thinking about the duration argument, that further out the curve, it's not obvious that you're going to see this sustained massive rally in bonds.
And protect the other side of your portfolio.
And exactly. And I think that's also something that, this gets ahead in the conversation a little bit too, thinking about the role a Canadian dollar underweight plays as a mitigant to not necessarily trusting bonds to really provide defense in a 60-40 construct. But I think just before we get there, maybe we can just talk a bit about the US as well. So again, if you get the soft landing narrative, you won't necessarily see the Fed cutting as much as what the market has priced. And we've seen little shadows and little examples of this as well, that the bond market gets a little bit ahead of itself and pricing a whole pile of eases. And then
at the beginning of this year, where we were at 6 or 8?
Exactly, yeah, 6 or 8 cuts at one point, and that proved not to be the case. And we saw that rally in bonds really unwind. So we don't want to get whipsawed by any of that activity. So, keeping a fairly close allocation to duration, close to our benchmark, I think that makes a fair bit of sense, and not necessarily buying into the narrative that the Fed will be cutting as much as the Bank of Canada. So we want to be thoughtful in terms of how we express that view.
Fantastic. This is fascinating. Some great questions coming in. Let's put these to you. So if GDP is slowing in Canada, David, should we be positioning our portfolios elsewhere, like the US or beyond? You've gone to that to an extent. Maybe just circle back. Yeah,
so generally, if you have a long investment horizon, I think there's just more opportunity outside of Canada. So the risk reward at this stage, is consistent with having that underweight to Canada. If you have a shorter term horizon, and again, this is reflecting the tactical flexibility we can bring into our portfolios, a lot of that bad news has been priced in. So trying to gauge the right size of that underweight to Canada requires us balancing those shorter term considerations. So as I mentioned, we have trimmed a little bit of that underweight to Canada. Again, I want to say very clearly, we're not overweight Canada, we're not overly optimistic on Canada, but we just think there's more opportunities outside of Canada's borders when it comes to an equity market investment.
Okay.
I should also make the note that that doesn't mean that every single Canadian company is going to be tarred with the same brush. So our underlying portfolio managers who are choosing among Canadian equities, they can still find a lot of opportunity. Right. Just from where we sit as an asset allocator, do you want to be in Canada? Do you want to be somewhere else in the world? We just think, again, the balance of risk points us to being outside of Canada today. Okay,
fascinating. So here's a question coming in. David, do you think the Bank of Canada will drop rates faster with elections coming up on both sides of the border?
Right. Well, that's definitely an intriguing question.
That's not loaded. Go for it.
Not at all. So at least the election we know with certainty is happening south of the border. So I think, again, that's an interesting story, because if you think about it from the perspective of Canada, and I don't want to weigh in on who will win the election per se, but I think there are some commonalities between both parties, one of which is more fiscal spending, I think. So that'll be probably more relevant for the US, but I think both political parties are sort of continuing the notion of being a little bit more protectionist. So as I mentioned, from the Canadians' perspective, if you're looking at your closest trading partner as becoming a little bit more protectionist, that's not going to help exports necessarily do very well in that scenario. So on the margin, that slows the rotation to export-led growth that we would want to see in Canada. So all things equal, that would at least contribute to the risk that the Bank of Canada would have to cut even more facing that type of outcome.
Here's another one. David, if the Bank of Canada does lower interest rates rapidly, could this lead to another inflationary surge? Yeah, would we just go out there and borrow, borrow, borrow?
Right, and that's the moral hazard that exists. So there's that notion of being too big to fail that applied to all these globally systemic banks and other large investors. Now it almost seems like everyone's too big to fail.
Right,
so
that's
you
so
can't
interesting. Everyone's so indebted.
Yeah, everyone's so indebted. So the risk is that you're just going to kick the can further down the road. So you cut interest rates a bunch, and then everyone relevers, and this only just postpones inevitable pain. So again, I don't think the Bank of Canada is going to be able, or hopefully in this scenario, doesn't cut to the point where we're at those COVID era lows. So there will be some adjustment that's necessary. I think that's fundamentally a good thing for the economy over the longer term. So we have to, again, like every other economy that's gone through this debt cycle, we have to take our medicine, and that does lead to a period of economic underperformance and certainly challenges for individuals who are overextended. But if you get through that and you're on the other side of that, that's again one of the reasons today why the U.S. is less interest rate sensitive, is because the household balance sheets are in a much better position, so they can withstand some of that policy tightening, whereas Canada unfortunately cannot.
So with all that you've said about actually both sides of the border and the different economic situations that each of them are in, and ultimately what's a good investment within there, is there a sense of there's a lot of action coming up over the next little while on monetary policy and otherwise? You just kind of keep walking? Is that your message?
That's the remit, is always to stay diversified. And again, we think of these opportunities as presenting themselves both on longer term horizons, but also some shorter term tactical opportunities as well. So we're making those calls, we're pulling the levers to make sure that our portfolios are, again, not only just well diversified, but finding opportunities at different horizons. So that's really the mantra that we try to take to the funds.
Okay, the final message in all of it. David Tulk, a pleasure to speak with you. Thank you very much.
My pleasure, thank you.